Good day, traders. This is Roger Scott with another video tutorial for you today. Before I begin, I'd like to remind you to subscribe to our video channel for video updates and trading tips. And please visit MarketGeeks.com for your free swing trading report. During the last 2 days, I presented basic techniques for beginners who want to learn technical analysis trading strategies. More specifically, I focused on my favorite indicator, the exponential moving average, or the EMA for short. The first day, I covered the basics of the indicator and demonstrated the difference between the simple moving average and the EMA. The EMA proved much more responsive to short-term price fluctuations and demonstrated better response to momentum and volatility. You can see by looking at this chart how much more responsive the EMA is compared to the simple moving average, or the SMA. After adjusting the EMA to 20 days, I demonstrated the precise entry method that we will use to enter the market using the 20-day EMA. The basic principle is to use the EMA to measure pullbacks away from the trend. We simply find a stock that's trending strongly above the EMA. The more distance between the stock and the EMA, the better the trend. The next step is to wait for the stock to trade completely below the EMA for 5 days or less. If the stock trades below the EMA for more than 5 trading days, the trade is nullified. And if the stock trades completely above the EMA within the 5 trading days, you would enter a buy stop order above the first bar that trades completely above the EMA. The last step we covered yesterday was where to place your stop loss level so that random price fluctuations or market noise doesn't cause you to be stopped out prematurely. My advice is to place your stop at the EMA level immediately between the last bar that traded completely below the EMA and the first bar that traded completely above the EMA. This may sound a bit confusing, so take a look at the example for clarification. The final step is to strategically place your profit target, and that's something we will cover in today's tutorial. You want to make sure and place your profit target at a level that provides you with a solid risk to reward level. Most professional traders use a profit to risk ratio of 2 to 4. This particular method is based on short-term price momentum and volatility. Therefore, using a profit target that's designed to keep me in the market for a long time will not, I repeat, not work with this type of strategy. I simply measure the distance between my entry price and my stop loss level and multiply that number by 2. I then add that amount to my entry price, and that becomes my profit target for the trade. This ratio offers me a reasonable risk to reward ratio. An increase in volatility provides me with opportunity to take quick profits from the increase in volatility before the momentum dries up once again. In this particular example, the distance between my entry price and my stop loss level was approximately $2.25. I would multiply that number by 2 and add that to my entry price, which in this particular case was $28.60. I then add $28.60 to $4.50, and my profit target in this particular case would be $33.10. In this final example, you can see exactly where the entry and the protective stop loss levels are placed. Since we are selling short, we would subtract our risk level from our entry, and that would provide us with our profit target. In this case, the risk level on the trade equals $3. We would multiply that number twice and subtract it from our entry price. Since our entry was at $158 and our risk level was $3, we would subtract $6 from our entry price, and that would provide us with a profit target level of $152 even. Always remember that pure momentum strategies are based on volatility and have lower profit to loss ratio than other technical trading methods. Also remember that the 20-bar EMA can be adopted to any market and time frame. The only market I don't recommend you trade using this method is options. If you'd like to learn more about this strategy or have any other questions, please don't hesitate to contact me at rscott@marketgeeks.com. That's it for today's tutorial. Thanks for joining us. Please don't forget to stop by marketgeeks.com to pick up your free swing trading report. And don't forget to subscribe to our channel for swing trading videos and trading tips. This is Roger Scott wishing you all the best in your trading.